You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate and multifamily expert Jim Singleton. Now, Jim is Senior VP and Principal of Acquisitions for Bascom Group and is responsible for the analysis, due diligence, equity and debt financing, and transaction execution functions for the acquisition of new assets, as well as the management and disposition of existing assets. As a member of the acquisition team, he has been directly involved in the acquisition of 35 multifamily properties located in California, Colorado, Nevada, and Texas, totaling 7,751 units and $1.2 billion in project costs. Now, here's what you're going to learn in our call today with Jim. You're going to learn what Jim's role encompasses as Senior VP and Principal of Acquisitions for a multi-billion-dollar multifamily operator. You'll learn which markets he focuses in and which are on his radar as up-and-coming growth markets. You can learn how they're managing their operations, considering that they feel we're near the top of a real estate cycle. You can learn how he feels their underwriting process is one of the primary strategic advantages that has put Bascom as a leader in this space. You're going to learn about how Bascom's projected investor returns have changed from 2013 when Jim joined the Bascom Group to the present day and what factors have been influential in that downward trend. You're going to learn how they're able to gain a strategic advantage when making offers against other highly competitive operators. You're also going to learn how they choose new markets to invest in and what that initial litmus test looks like. Additionally, where the income to rent ratio comes into play in the selection process and much, much more. And so with that, guys, I'm excited to get on to the show with Jim. But before we do, I have a few quick housekeeping items I'd like to run through. Like I do each and every week, I like to go through my one personal best and one professional best from the prior week. So I'll go ahead and start with the personal best. Last week, my wife and I actually had the luxury of taking a trip down to St. Lucia, and we spent some time there for 4.5 days, just getting away at one of the island's nice resorts. And it was an enjoyable experience. It was great. But there's only so much relaxing that I personally can do before I start getting a little antsy. I can't just sit around on a lounge chair, reading a book or listening to a podcast for days in and days out. But I really enjoy some R&R, and we had the opportunity to get that. And so it was nice being there, but it was also nice getting back home. The one highlight I think of the trip is I did go out fishing one morning in our boat, along with a few other anglers that were on board. We reeled in 7 decently sized blackfin tunas, and so we ate really well for the following few days, as we had the chef there at the resort cook up our catch in a variety of different ways. So that was a lot of fun. However, after all of it, it's always really good to get back home. I really enjoy where I live, and I enjoy getting back into a normal routine. So moving on here, professional best. We recently sold one of our mobile home parks in Kentucky. We purchased this park just over 3 years ago. This was a smaller park, 68 units in total. And I'm happy to say that after executing our business plan, we're able to pay our investors a consistent 8% annual return for the 3 years that we owned it, with an overall return on investment of 37% after the sale of that asset. And so this was a huge win for all parties involved, and we were actually able to exit this property and sell to the largest mobile home park operator in Kentucky. And so we were able to sell at a premium price, which is always a nice thing. Moving on here, guys, if you love what we're doing here at the Real Estate Investing for Cash Flow podcast, be sure to subscribe to the show and also take a moment to leave a review and rating if you haven't done so already. And lastly here, guys, before we get on to the show with Jim, just want to remind you of the free 30-minute phone call that I offer each and every week. I typically open up 2 to 3 time slots every Friday where you could basically get on the phone with me and talk about anything and everything your heart desires about real estate investing. There's no ulterior motive here. I won't try to pitch anything. This is a way for me to connect. I've been doing these calls for now going on 5 years. And so if you want to sign up for one of those calls, go to kevinbupp.com and get it scheduled. And just one last thing here before we get rolling. If you schedule that call, be sure to put some notes in there as to exactly what you'd like to speak about during our time together. That will ensure that those 30 minutes are spent as most efficient as possible. And now, guys, without further ado, I'd like to get on to the part of the show that you've been waiting for, which is our interview with Jim Singleton. So here we go. Guys, it's my honor to introduce my guest for today's show, Senior VP and Principal of Acquisitions for the Bascom Group, Jim Singleton. Jim, how you doing today?
I'm doing well, thanks. How are you, Kevin?
I'm doing fantastic. Very much looking forward to having you here on the show. For those that don't remember, we actually had Jerry Fink on the show a few different times in the past. I think probably the first time 4 or more years ago, and then more recently, probably in the past year. And Jerry is one of the founders of Bascom. And just to provide you guys a general perspective of who Bascom is. The company was founded back in 1996 and has completed, I'm sure this number is even larger now, has completed over $15 billion in multifamily and commercial value-added transactions. And that includes more than 600 multifamily properties and 160,000 doors. And again, these statistics were from, I guess, over the past year when I had Jerry on the show. And so I'm sure that Jim will probably correct me because those numbers have probably changed. So they've been steadily making additional acquisitions and adding to their holdings. And so with that, Jim, again, welcome to the show. Very, very excited to have you here. If you could, for those folks that don't know about Bascom, and again, I just gave the high level point of view of who Bascom is and what that holdings looks like, but maybe you can give a little bit of the history of the company, and then also, exactly what your role is there at the company.
Yeah, absolutely. Very, very happy to be here on the show today. Looking forward to spending this time together. As you mentioned, I'm a senior vice president with the Bascom Group and principal focusing on acquisitions. Our company was founded in 1996 by David Kim, Jerome Fink, and Derek Chen, who are all University of Wisconsin alumni. They moved out to the West Coast and started focusing on acquisitions in Southern California, and over time have expanded to a national presence with a focus in the Western U.S. So my target markets are mountain states, Utah, Colorado being a focus, and then the Pacific Northwest. So Portland and Seattle. I'm also focusing on growth markets, smaller secondary and tertiary markets like a Reno or Colorado Springs or Central Valley, markets that might not be on the institutional radar, but where we think that there's good potential for growth. And to your point about our current volume, we're up to $16 billion in transactions. We've been active this year, more focused on, I think, portfolio management and doing a lot of refinancing and disposition. As we've gotten late into the cycle, some of the acquisitions have been harder to find, being that the market has gotten so competitive. So that being said, our portfolio is just under 20,000 units right now. I think we're in 14 states and heavily focused in the Western U.S., being that we're based out of Southern California.
Got it. Fantastic. So tell me exactly what your role looks like there in the acquisition side of things. I mean, you gave us a general overview of the states that you focus in, the different markets that you play a role in, but ultimately, what does that day-to-day look like for you?
So day-to-day basis, I think our secret sauce is really underwriting. We're out looking at as many opportunities as we can, so that we can find the best relative investment opportunities for us. So on a day-to-day basis, I'm reviewing our underwriting and looking at potential new leads across my markets. That's a core responsibility. And then if there's anything that's active on a transaction basis, whether that's an acquisition, a refinance, say we're putting a new loan in place with a lender, and typically what we're doing is taking a bridge loan and have some sort of value add improvement component of our loan, and that's structured in. And maybe if we hit the end of our value add, we'll put a new longer term loan in place. So that would be a transaction responsibility or a disposition. So those are taking anywhere from 30 days to 90 days once they're signed up and we're moving forward. But I'd say that it's a good split between deal sourcing and finding our next opportunities and transaction execution.
Got it. Of all the deals that come across your desk, Jim, let's say it's 1,000, how many of that 1,000 in any given year, again, I'm just throwing out a number, you can pick a number you want, but how many of those actually get underwritten? Of the ones that get underwritten, how many offers are made? And out of the offers that are made, what percentage do you end up purchasing?
That's a great question. So I would say that anything that comes in to us as a lead, we want to underwrite. And there are different levels of underwriting. We use very basic valuation metrics like a GRM, a gross rent margin, and that'll tell us, okay, is this in the zone of where we think the pricing should be? And that's just taking the total monthly rent, multiplying it by 12, and then dividing whatever the price of the opportunity where the pricing is by that number to give us a GRM. So historically, we've kind of hit a limit at 15 GRMs, and so that's a really quick back of the napkin way for us to do an underwriting. And then it goes much deeper into, let's look at the rent roll, let's look at the submarket, let's look at the supply situation, the supply circumstances if we have competition coming online. But I'd say that we underwrite as much as we can. We tend to be more of an institutional investor, so 50 to 100 units and higher. We'll do a little bit smaller in Southern California because it's our backyard. But anything 100 units and higher in the markets where we're targeting, we'll underwrite. I'd say that we underwrite 200 deals a month in my markets, and of those 200, we're offering on 40. I'd say we're competitive on 15 to 20 based on broker guidance, and of those 15, if we land one, we're happy. So we cast a very wide net, and it kind of scales down based on how close we are, and it's competitive out there, and ultimately if we end up landing the acquisition.
Got it. But, it is competitive. I mean, the landscape has changed drastically over the last 5 to 10 years. And so, speaking to, I guess, your time of starting at Bascom, which is 2013. What have you seen to be some of the monumental shifts? Maybe not just with like your overall investment strategy, but just with the market in general, how you guys are adapting to it.
Yeah. So, since 2013, a lot has changed. A lot has changed. The market has really evolved. In 2013, I think we saw in 2012 is there was a big release of liquidity back into the market, and people were able to start transacting again. When we hit the downturn in 2008, 2009, 2010, there were, major solvency issues, and people were, there was less of an appetite for risk and going into the multifamily market where maybe there were some scars. So in 2012, 2013, we really started to see volume pick up again. And from then until now, one thing that has changed the most for us is our underwriting returns. When I was starting here at Bascom, we were underwriting to call it a 16 or 17 investor IRR. Today, it's low double digits. So, a lot of things have influenced that. Debt, cost of capital, right? Rates have come in and have been low, and so I think the appetite for a call it low double digit investor IRR or rate of return is strong, being that the interest rate market is so low, and your alternatives for investing and opportunity is, it is low. So that's one component of it. We've seen construction costs go up, so that kind of eats into our cost of doing, our total cost in making an acquisition, right? So 2013, 2014, we may have been doing a washer and dryer installation on a unit for $2,500, and today that could be $5,000. So costs are up, in that respect, and that's a sign of a healthy economy and a lot of construction taking place. So returns reducing and some construction costs going up. Those have been a couple of big themes for us over that time.
Got it. From an underwriting perspective, what are some of the risks that you guys look for as far as like the coming years? And I know that you guys ebb and flow a lot with your holdings. You're typically like 3 to 5 year investors with each of these acquisitions. I'm sure that you have some that you've owned much longer than that. But would you say that for the most part, you typically look at a 3 to 5 year horizon on most acquisitions?
Yeah, I'd say we look 5 year. It's a 3 to 5 year window, but we're underwriting 5 years consistently. And that just keeps it uniform across our investor base. So Bascom is a sponsor. And so anytime that we're doing an acquisition, we're most times we're finding a limited partner who's going to partner with us in the investment. And so being that we want to keep consistent in our offerings, we underwrite everything to a 5-year hold. And, I'd say that we are very proficient in executing a reposition within a 2 to 3 year window. Mm-hmm. But our average hold over Bascom's history, I think, is just over 4 years. So, to keep it consistent, we underwrite to 5 years. And
how do you typically underwrite the risk of? No one knows what the capital markets are going to be like in 3 to 5 years. I mean, as far as the potential moving target of exit cap, how do you factor that into the equation when you're doing the underwriting?
Exit cap is huge, right? I think your cap at exit is a major driver of your value. So how do you pin that down? And for us, we've seen, and feel that a good norm and a good approach that's generally received well in the industry is a 50 basis point increase to our year one cap rate. So if we're buying a deal in California at a 5 cap, that may adjust down after, we make a real estate tax adjustment and say our year one cap rate is going to be 4.5. We'll put an exit in at 5. So a 50 basis point increase over our year one cap rate is how we underwrite the cap rate 5 years down the line. In terms of interest rates, Bascom is most of our loans are floating rate loans. We like flexibility in exit, so we don't want to find ourselves in a position where we have a large prepayment penalty because we've structured a fixed rate loan. So we're taking a forward curve from a rate consultant who, which we incorporate into our model. So based on future treasuries, they can derive where LIBOR will be 2 years out, 3 years out, 4 years out. And that's how we're forecasting our interest rate risk.
From an acquisition standpoint, how do you guys get that competitive advantage? I mean, when dealing in your different markets, so just speaking to the markets that you're in charge of, that you oversee, the various broker relationships that you have, obviously there's lots of competition out there. You guys obviously have done a lot. You've got a long, strong track record of execution. However, there's other folks out there that are probably equally as strong that have also a long-standing track record. How do you guys find to get yourself that foothold or that competitive advantage when there's multiple other bidders on an asset?
I'd say it depends is the answer to that question. In markets where we have a large presence, I think the scale gives us an advantage, and we can underwrite to maybe a lower expense on a per door basis because we have scale in that market and can share costs amongst properties, whether that's structuring a cable contract or a landscaping contract that's favorable to us because of the scale and the size that we have in that market. That's a differentiator for us. And then, I think the relationships are important. And surety of close. We present ourselves and like to step in as a solid buyer where our counterpart can have confidence that we're going to execute on what we're stipulating in our initial offer. So, kind of combining that together, it's if we can be present through our relationships in the brokerage community, both on an on-market and off-market basis, they can pitch to potential sellers our strength as a buyer and ultimately put something together for us to acquire.
Got it. From a market perspective, how do you make the determination of considering another market to move into? I know that prior to us going to the recording here, that you made mention of some of the primary markets you're in, but also some of the secondary and tertiary markets that you're also spending some time in. What does that initial litmus test look like in some of these markets that you might not have a significant holdings in, or literally you're just looking to get your first acquisition? How do you make that final determination of like, this is the place we want to spend some time, we want to spend energy, and we want to create some scale here?
Yeah, and I think it's kind of just staying on top of a lot of the, what's going on in the industry, right? So what are the high growth markets, right? Where are we seeing high growth? And that might be in an Inland Empire or Reno or a Colorado Springs. So we start paying attention, or we'll pay attention to things like that. And we have our own analysis that we'll do, looking for markets where, maybe there's a good income to rent ratio, right? If the incomes are high in a certain market and rents are low in a certain market, then, that your renter is going to have capability to make their rental payments, right? Los Angeles is a good example of that, to the contrary, where I think the average rent is average annual rent is about half of what the average median income is. So, it's not a very healthy rent to income dynamic there. So those are the little things that we pay attention to, as well as big news. Reno is a good example, right? So Tesla and Panasonic have their battery factory out in Reno, and that's driven a big shift in that market. And so that's one that we're staying on top of. And as we kind of key in on markets like, Reno or Colorado Springs is a good example. We've seen a lot of growth in Colorado Springs and a lot of good big economic things happening there, like Amazon putting a 4 million square foot industrial complex in down by the airport. It's we start to keen in on those things, and then from there we move into our broker relationships and start making connections through other brokers or relationships that we have to slowly make headway in those markets. And and it's not it's not a fast move. It's not something that we do immediately. We say, hey, this ratio or this number is exactly where it needs to be. Let's back up the truck and buy as much as we can. We tend to start triangulating on those markets and spend time in those markets, a good year or 2, 3 years before we actually make an acquisition. And that time is more time spent getting to know the market, establishing the relationships, and getting our sense of where the market is, so that when we find an outlying opportunity, we know it's time to strike.
Got it. Speaking back to the income to rent ratio, what is that what is that percentage or the ideal formula that you're looking for there? What gets you super excited about a potential market? Just based on, I know there's other factors involved, but just from an income to rent ratio basis.
Yeah, I mean, I think anywhere from 20 to 30% is very healthy. I think above 40% is that's where you say, okay, hey, let's hit the brakes here and think about really the cost and at a certain point it's you want to be smart about knowing what people can afford, and that's a there's a big shift in more people moving into rental housing and single family homes becoming less and less affordable. So it's that's another dynamic that we're paying attention to. And so we want to be in markets where we know there's job growth and we know there's healthy economics and healthy employment. I mean, if there's one thing that we track more than anything else, it's employment growth. I mean, correlation between employment growth and rent growth is almost 1-to-1. It's tremendous. So it's you want to be in a market where the fundamentals are good and they're sound, and there's going to be demand for rental housing.
Got it. I forget all the different states that are within your territory as far as acquisitions are concerned. But regarding rent control, are there any states that you're currently in charge of that have rent control in the books, or that currently are part of the law?
Yeah, so I do acquisitions in California and Oregon. So that's on our radar.
Talk to me about underwriting there. I mean, exactly how do you adjust for that, the risk associated, not with just the current rent controlled jurisdiction, but also any, future legislative changes that might come down the pike. Because I feel like, there's just a lot of activity, lots of momentum moving around that topic nowadays.
Yeah, I think you hit the nail on the head talking about future legislation. As the legislation is written today, I don't think it's really a major impediment to our underwriting. We're not seeing big shifts in terms of how the market is responding to potential opportunities in markets like California and Oregon. But those are markets where your top line growth is per the legislation. It's 5% plus, right? It's the markets like New York where it's 2%, where I think we're really seeing people pause and be a lot more cautious. And we have partners that are out in New York that are a lot more exposed to that on a day-to-day basis, and we see them having a higher sensitivity, I think, because of that exposure in their home turf. So today, the way that it's written now, I don't see us, we're being cautious of it, but I don't see any major changes in the underwriting. I think there's more concern about future changes to legislation. If that, 5% in California or 7% in Oregon gets cut down to 2 and 4 respectively, then it's a big change. So we've worked hard to get an understanding of what the exposure is and how things have changed, and have educated ourselves and our partners and potential investors and other people on what the changes are, and are just trying to be thoughtful about how anything may change going forward. And that's just, it was Oregon first, right? And then California second. So, there's certainly debate about that in other markets. And, I don't think it's something that is going to temper. I see it only growing, right? So I do a lot in Colorado, and it's certainly part of the conversation there as well.
Mm-hmm. What has you excited today? I mean, generally speaking, of Bascom, any particular projects that just has you all jacked up and excited about what you got going on?
Yeah, I mean, I think I would say the growth markets are what, it is what has me excited. I think there are a lot of areas where you're seeing the move of, where people are moving out of places like California and into, Nevada or in Idaho or, in Colorado, going into Colorado Springs. So those are the areas that, where I get excited. It's thinking about, okay, what's the next Nashville? What's the next Austin? Where are we going to see, a lot of growth going forward? And, today is it the right time to be chasing those markets hard? You certainly, when you're going in and you're on a 3 to 5 year hold, you have to think about your exit, right? So you're going to have maybe less appetite from a buyer pool in a smaller market. And, that said, it's, kind of thinking down the line. It's we're going to be the next big exciting areas to invest and really see growth in the cities.
I know that your typical time horizon is 5 years, but do you ever go in, like some of these markets, if they just, not knowing what the future holds, maybe they don't grow as fast as what you anticipate? Do you guys have a plan B to where you've held assets, or that you might intend on holding assets longer than that 5-year horizon? I mean, maybe it ends up being a 10-year play? Yeah,
absolutely. And I think that's very real for us today, being that we're late in our our cycle, in our growth cycle. It's the thought of a slowdown or recession is certainly on everyone's mind. And so, I think that when we're structuring deals today, whether it be on, an equity or debt basis, we're thinking a little bit longer term and trying to, maybe structure a little bit more term on our loans, so that, if there is a little bit of, a little bit of a slowdown or a rough patch in the market, that we have structured our investment to to carry through on a longer term. So, before my time, we here at the Bascom Group, we acquired a lot going into the last downturn, and anything that we held long term, worked out well for us, right? So it's you want to be able to kind of shore things up and batten down the hatches if there is some disruption in the market and be able to go on. So
or just even think of like your floating debt, right? Like most of the debt that you guys put in place is floating, just so you're not binding yourself or bounding yourself to long 10-year term fixed debt that has a very high prepays associated with it. Or defeasance. And so just, I'm wondering what that time frame looks like if you guys go into, to an acquisition. Now you realize like, hey, I know that hasn't really happened during your time, right? I mean, historically with Bascom, I'm sure 2006, 7, and 8, maybe there were some things that were floating that ultimately got, converted to perm before, I guess, shit really hit the fan. And I'm just wondering how that thought process works behind the scenes, with some of these, newer growth markets. That's so I don't know if it's maybe you can't answer the question. I know that's such a open-ended question to ask. Especially at this point in time.
Simplistically, it's like, okay, let's do, instead of a 3+1 or 3+2, let's do a 5+1 or a 5+2.
Yeah.
If we can find a lender who's going to give us that kind of term, that might be something that we push for. And maybe you're sacrificing a little bit on your rate and are paying a little bit higher rate, but 10 basis points annually for an additional 2 years of term, I mean, it's a good trade, right? So those are the things that we're working around. And we find that there's a ton of liquidity in the market, right? From an equity and a debt standpoint. So when we go out and we're looking at opportunities and we're going to the debt market and saying, hey, here's a financing opportunity, we try to have that conversation with our potential lenders and say, look, this is what we're looking for, and who can work around that. And so, that additional term is helpful. Back to your point about growth markets, right? It's kind of this. It is one thing that gets me excited, but it's also you do have to be cautious going into those markets because of how much is trading there, right? So, a big part of our business plan is the exit, right? And so if there's not a big, if there's not a lot of trade volume, on an annual basis, it's, I think that's something that we need to be cautious of and treat appropriately. So, but, again, it's like, we believe in the lifestyle communities, right? Denver is a market that has blown up and we've been investing there since the early 2000s and have seen our portfolio kind of ebb and flow up and down. But I think, it's a good example of, hey, let's go invest in multifamily in cities where people want to be. And Denver is a good example. I think some of the cost of living has gone up, but it's, that's a very diverse economy and you have the mountains nearby and relative humidity is low and there's a great airport and the infrastructure is good and there's a light rail. And so those are the things we get really kind of excited about as we find these new markets to chase and really lean into.
Yeah. No. And just, you mentioned lifestyle communities. What does that mean to Bascom? Can you define that?
I mean, I'd say that, it's really, where people want to be, where they want to live, where they have access to good jobs, good, good local amenities, attractions, entertainment centers, it's, so like Reno is a good example, right? Reno, you're an hour from Lake Tahoe. You have a lot of the job growth in Tesla and Panasonic. I think we're seeing a lot of people move out from California into Nevada because of the tax benefits of the state. So, okay, what's lifestyle in that context? It's proximity to the mountains. It's proximity to the lake. It's beneficial tax structure. It's a town with some good restaurants, good bars, whatever it is, somewhere where you can, kind of plant your flag and enjoy living there.
Yeah, I understand. I didn't know if you were referencing when you said lifestyle community, if there were certain amenities with your communities that kind of help you guys define calling yourself or calling your communities lifestyle communities. That's all. I didn't know.
I think I was thinking more macro on that, more about kind of the cities in particular, less about our individual apartment communities and more about where we like and see future growth.
Got it. Well, Jim, lots of great information shared here today. I really appreciate you coming to the show. Now I'd like to enter into what I call the golden nugget segment. This is where I'd like to ask if you just had one final golden nugget of advice or wisdom that you could leave with our listeners that may inspire and motivate them as they progress in their real estate investing career. What would that one last golden nugget be?
I would say that, personally, from my experience, my growth as a real estate investment professional has come from exposure and doing deals, right? So the more I've been able to see and the more I've been able to transact, the more I've been able to digest and really get an understanding of how to be a good multifamily investor. So, it starts with underwriting, but you're getting the most growth in actually working on live deals. So I would say, get out there and work on deals, whether it's, a simple acquisition, a duplex, a triplex, something small, or restructuring the loan that's in place. It's on your acquisition or in your portfolio. It's transacting that's going to get you experience, that's going to make you better and position you in a situation to ultimately transact more favorably for your investments.
Yeah. Simply put, take action, guys. Get off your butt and take action. Nothing's going to happen unless you do that. That's a starting point. So, Jim, really appreciate you coming on the show. It's been a pleasure having you here. Folks, if you'd like to learn more about Jim and the Bascom Group, you can go visit their website at www.bascomgroup.com. Again, that's bascomgroup.com. And Jim, thank you for coming on the show. Thank you guys for tuning in to this week's episode. And until we meet again next week, this is Kevin Bupp wishing you huge success. You take care. Bye-bye.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.